I'm trying to paint a picture for you guys to understand what really actually moves these markets. I could not imagine being a retail trader that actually thinks that this $1.4 billion event that took place, that happened today, is what is the reason as to why assets across the board outside of ETH bled today.
Listen, I'm not. I don't profess for 1 second that technical analysis is not important. It is important because it provides a very good head check to overlay onto fundamentals.
We still got some people jumping in. I see the numbers just jumped up to 36 people on the call. Can you guys see my screen?
Yeah.
Okay, cool. So yesterday in our Zoom call, I just want to again show you guys how you all have a mentor in this space that actually knows what the heck he's freaking talking about. Okay. We've been going over fundamentals all week, right? We've talked about what things would weigh on market sentiment, higher inflation expectations. Even that's not even stuff I told you guys. Remember, we conjured that list at the beginning of the week together, right? Any data that weighs on rate cut sentiment yesterday, we know after reading the fundamental report and doing a digest, what were one of the main drivers yesterday driving market sentiment? It was rate cut expectations that was increased by Fed Bostic's dovish comments, right? All of that pretty much diminished from the market today. And we called all of this in advance. Yesterday, publicly, I dropped the video breakdown for the internet to see how easy this is, where I literally told everybody that the market would sell from a premium. This was 30 minutes and 47 seconds into this Zoom or into this video that I made yesterday that I dropped on X and I dropped on YouTube for the world to see how easy this stuff is. Okay. Where if we poked up into last week's or Monday's highs and the market was euphoric, even if the market's euphoric, it doesn't matter. The market's not going to continue to go up. The people that control these markets aren't going to continue to buy risk assets if the sentiment doesn't call for it. So inversely, if we see any new breaking headlines surrounding tariff implications, trade war escalations, any new geopolitical sparks that create fear, uncertainty, and doubt in the market, or any strengthening in the economic data from the US front that pushes back on the current rate cut optimism, we're most likely going to see some profit taking in these premium ranges. Whether that's we continue to tread a little bit higher, rolling into Asia and London session, for Asia and London session to be able to sell at a premium and gather up some buy momentum to create liquidity underneath of lows, and then a reversal, or we just see some profit taking from where we currently stand, correcting some of this week's bullish move, making our way back down into the weekly low over the weekend, coming in at about $3 trillion. Under those market conditions, this is the technical analysis that would most likely play out. A rejection of last week's high, a failure to hold above this week's high, and a correction of this week's bullish move. So what happened today? We poked above last week's highs, and right at the time, it's just interesting how it all pans out. Right at the same exact time that the market liquidated last week's highs, news came out weighing on the overall sentiment surrounding rate cut bets later this year, and the market freaking tanked. At the same exact time, I try to show you guys in this call not to pay attention to retail fundamentals, because at the same exact time, what started breaking? Cointelegraph, which I showed you guys in yesterday's call in this public, video that I dropped. They are a freaking joke. They are a distraction. They are part of the paid schematic, in my personal opinion, to manipulate the minds of retail investors. Breaking, Bybit confirms ETH's cold wallet was compromised due to a UI spoofing attack. And it says here how much money was drained, $1.4 billion. Okay. I just want to show you guys from a market perspective, okay, how small $1.4 billion is in the total crypto market using the measuring tool. Look at this. Okay. That's $1.4 billion right there. Look how small that is. Do you think that that's what moved the markets this morning? No, not at all. Okay. But from a retail's perspective, they're going to read this. Look at how many impressions this probably already has. 84,000 impressions from this Cointelegraph article, Watcher Guru, 164,000 impressions. So the retail mind is like juiced out right now. They're like, oh my gosh, cold wallet compromised. That's why the market's tanking. No. Oh my goodness gracious. It drives me up the freaking wall when I see this stuff because it's like straight up paid misinformation. Like somebody has to be paying these companies, Cointelegraph and Watcher Guru, to just straight up manipulate the minds of the masses. Or maybe they just don't know. I don't really know what it is, but it's so crazy to me that it exists. Okay. I created this community for you guys to be able to do what I do, right? Which is tap into the info that actually matters. We called this pullback out. Look, you guys see on the charts, I didn't say that the market was going to tank to 2.5 trillion. I didn't say we were going to correct the entirety of the whole entire week's move, nothing. I just simply said if the data intraday today came out, weighing on rate cut bets, we were most likely going to see some type of market correction. Now here we are. What I drew publicly for everybody to see, the world to see yesterday, has come under fruition. I'm taking advantage of those opportunities because the higher time frame, when you zoom out the macro, even though we see all these little tiny intraday things that drop the market sporadically and create these shocks, we're bullish. Like we're seeing institutional adoption on a granular scale. We're seeing ETF approvals, ETF inputs getting put out left and right. We're seeing regulatory developments happening. We're seeing the most bullish political support for crypto that we've ever seen in the entire 16 years or 15 years that crypto's been in existence. Like if you're not buying these dips, I don't know what to tell you guys. Okay. So I just continue to tell you what I'm doing and it continues to work. So I want to show you guys how I try to give you guys these little tiny gems in advance. So, publicly putting out information that this correction was most likely going to happen, showing you guys the distractions. I'm just going to constantly keep doing this for you all until it really starts to click. Not saying that paying attention to this info is not good, but it's just not what matters. If I'm being completely honest, it's irrelevant. Learn in your investing and trading career to eventually just wit out the noise. It's hard to do. Believe me, it is hard. Even myself sitting here at my computer for 8, 10 hours a day, it's hard not to look at Cointelegraph or watch a guru because they're the trending things. But put that stuff aside for a second and just really truly realize what matters. Who moves these markets? Look at this. Okay, today, just as an example, this one freaking candlestick here today was a 30 to 40 billion dollar move, right? That's a $40 billion candlestick. Then immediately afterwards, we see a slight bullish recovery of the same volume and volatility, a $40 billion buy candle. Then shortly after that, we see almost $100 billion gone from crypto in one candlestick right after. Okay. That is not because of some ETH hack on a cold storage wallet. Okay. That is some major hedge fund institution, somebody who's got 30, 40, 50 billion dollars in terms of trading volume or orders moving these markets. When you can see that and you can cut through all the bullshit and the noise and you can call out these moves in advantage. I even told you guys yesterday on Mr. Aqua Zoom, I took profit on my Bitcoin trade. Look at the messages that I send you guys in the chat. What did I say to you all this morning before all the news came out? I said, Grand Rising team, market optimism from yesterday is carrying over into today. No major changes as of right now. However, make sure you all are paying attention. If you are day trading today, that you don't get caught in any greedy positions, especially if you're in profit. I'm not saying this because I'm some new person in the markets. I'm saying this because when the markets are greedy, when the markets are green, and everybody thinks because of previous day's price action, the market's going to continue to go up today, that's when most retail traders lose because they're greedy. They're too attached emotionally to these markets. And instead, they're not focused on consistent long-term gains over a steady period of time. That's what creates success. So I try to warn you guys, right? Go into the market, go into the SCAR, excuse me, go into the weekend profitable. If you're in good positions in the green and you know news fundamentals are about to come out that could possibly spark uncertainty, don't marry a bias. Take profit from those positions, right? You can always re-enter back into the market if you see another setup, okay? Following that, I also told you guys before the news came out, the way that I see it, the first half of 2025 will be a bunch of choppy bull crap, dead cat bounces, and random shakeouts. Then second half of 2025, rolling into 2026, will be when the real price action starts. I still firmly believe that. We're in the midst in a period in the year of 2025 where there's going to be so many different headlines that come out that we can already kind of see tariff uncertainty, geopolitical tensions brewing left and right, right? We have to get through those things, and those things tend to create a level of uncertainty. When there's uncertainty in the market, that creates shocks to risk assets. Shocks in the form of massive liquidations and intraday price action, but then a bullish recovery shortly after because higher time frame, the market structure and the sentiment is still super bullish. Short term, it might suck. We might see liquidations like we did today randomly, right? $100 billion gone from the market and then a swift recovery. But we got to be able as a community to take advantage of those opportunities. Again, not financial advice. I am, because the people that do and the people that take profit when you're in profit and reallocate that capital back into a discounted price are going to be the people that grow and build and compound and really capitalize on the moves that are coming that aren't quite here yet. It's not time yet, but it's coming. It's brewing. All right. So hopefully you guys are paying attention because in yesterday's report, we talked about what would weigh on market sentiment today. I'm going to end this report on a positive limelight because I think that this was just a quick market correction because of a slight change in market sentiment from what was driving the market optimism yesterday, which was primarily due to Fed Bostic's dovish comments supporting two rate cuts in 2025. So let's read thoroughly through this report. Okay, this is going to get a little bit boring because it goes into detail on all the fundamentals that came out today, but I want you guys to understand it. So I've written explanations out on each fundamental point as to why it temporarily weighed on market sentiment and why it caused these market makers to liquidate some of their positions at a premium right after liquidating last week's high, right? So after briefly touching a weekly high of $3.22 trillion in total market cap, the crypto market retraced over $34 billion, reflecting a broader pullback. That was when I updated this morning. I could have changed that a little bit, but still, you get it. The initial rally was sparked yesterday by dovish comments from Federal Reserve Banks of Atlanta President Raphael Bostic, which fueled hopes for imminent rate cuts. You could even see a retail article catching up with us here at CYPRX. This came out February 20th. We talked about this in our Zoom call and in our fundamental report from February 19th. Okay. However, newly released U.S. data, particularly the University of Michigan Consumer Sentiment Survey and flash PMI figures, contradicted those rate cut expectations. Markets do not like fear and uncertainty. Remember how many times I've told you guys that? So anytime you see fundamentals that come out that have those key vocabulary words in it, you can almost correlate that to the T of a degree with bearish price action or intraday bearish pullbacks. That doesn't mean that the market might not recover this weekend or continue to the upside, but intraday, the traders that move these markets that are large asset managers, hedge funds, I just say all these big names. Who knows who they really are? Central banks, whatever. They could be anybody. When they see these things, fear and uncertainty, they take profit and they reallocate that money into a discount. Okay. It would be stupid for anybody to ignore that that's what they do. You can clearly see that in terms of price action. So these two factors are now dominating the conversation amid indications of stickier inflation, weaker consumer sentiment, and heightened policy concerns. So let's go over the key data points and their implications from today. We had consumer sentiment decline. The University of Michigan Consumer Sentiment Index fell to 64.7 in February, revised down from 67.8, its lowest reading since November 2022. All five sub-indexes deteriorated, including a 19% plunge in buying conditions for durables, that's durable goods, reflecting fear of tariffs induced price increases. Here's the key word right there, fear. Sentiment weakened across all age, income, and wealth groups, demonstrating a broad-based reduction in consumer confidence. Why this matters. Lower sentiment levels indicate consumer growing apprehension about economic prospects, which can dampen consumption, the largest driver of U.S. GDP. If consumer confidence continues falling, it can act as a drag on growth, making investors question whether the Federal Reserve's policy path might remain restrictive for longer rather than quickly pivoting to rate cuts. Number three, we had inflation expectations on the rise. I highlighted this in red because this was probably one of the predominant factors today that weighed on yesterday's Fed Bostic dovish comments. The 1-year inflation expectations jumped from 3.3% in January to 4.3% in February. That is a whole percentage point increase, the highest reading since November 2023. 5-year inflation expectations climbed to 3.2%, up to 3.5%, marking the largest month-over-month increase since May 2021. Why this matters. These elevated inflation expectations suggest that consumers believe inflation will persist for longer. Higher inflation expectations complicate the Federal Reserve's goal of price stability and reduce the odds of near-term rate cuts. If you guys remember, in our weekly Zoom call logs, I don't remember who it was. It was a Zoom call from 2 or 3 days ago when we were, chucking out a list. We remember we typed it out on the Zoom call together and we were like, okay, guys, what's going to weigh on the market? Somebody said in the Zoom call, higher inflation or higher inflation expectations, either or. So you nailed that on the head. Whoever said that, if you're on this call, you can see now how when the data comes out, right, immediately or short term, that can create some fear, uncertainty, and doubt. So the market algorithms reprice that information in, drop prices, selling their profited positions at a premium, and then reallocate that capital back into discounted positions. All right. The Fed traditionally seeks to keep long-run inflation expectations anchored, so a jump in these indicators usually supports more hawkish or at least less dovish monetary policy, which was delivered yesterday from some Fed speakers. We also had mixed flash PMI figures. The services sector unexpectedly moved into contraction, raising concerns about the economic outlook. Manufacturing growth accelerated, but input prices rose and business expectations deteriorated, partly due to heightened uncertainty. There's another key vocab word. Over Federal Reserve policies. Why this matters. Divergence between the services and manufacturing sector can signal uneven economic performances, creating uncertainty about overall growth. Rising input prices also fed directly into inflation metrics, challenging the Fed's inflation fighting efforts. Last but not least, we had existing home sales drop. Existing home sales in January fell by 4.9% to 4.08 million, below expectations of 4.12 million. Although the Fed has enacted multiple short-term interest rate cuts in this scenario, unusually suggesting they had been cutting into 2025, mortgage rates have not fallen significantly, keeping housing affordability tight. Why this matters? The housing market is a key interest rate sensitive sector. If housing remains weak despite rate cuts, it indicates either rates haven't fallen enough to meaningfully stimulate demand or consumer confidence is too weak to support major purchases. This mismatch adds to economic uncertainty and pressures the broad market sentiment. Then I want to specifically focus your attention on Fed's Bostic dovish comments from yesterday. So Fed Bostic yesterday signaled to the markets at a possibility of rate cuts sooner than previously expected, sparking a short-term rally in risk assets, including equities and crypto. Here is a screenshot of pretty much everything that he said yesterday, so you can kind of see how the data that came out today pretty much contradicted everything that he said yesterday that created the market optimism, right? So new data versus the dovish tone. The surge in inflation expectations today, plus a marked drop in consumer sentiment, contradicts any narrative that the Fed can quickly pivot to cutting rates. At least right now, right? That's not to say that data that continues to come out week after week might further prospect the idea of Fed rate cuts, but intraday today, we saw some uncertainty in the markets, right? Any narrative that the Fed can quickly pivot cut rates, stubbornly high inflation, typically demands tighter or at least steady monetary policy, not easing. So as a result, markets were forced to reassess the likelihood intraday today of any early Fed pivot, reducing risk appetite temporarily and putting downward pressure on equities and crypto along with other risk assets. So overall, just here was an impact today from the data that came out. We saw a slight decline in equities. We saw the crypto markets initially drop after all the data came out. And we obviously, of course, are still seeing some slight fear, uncertainty, and doubt in the markets surrounding the economy, Trump policy implications surrounding tariffs and trade wars. And then obviously, of course, we have the heightened headlines right now surrounding geopolitical escalations and tensions, both in the Middle East, even though there's been more peace prospects in the Middle East, now also Russia and Ukraine situation. Okay. So, overall, it's very simple to see this stuff because at the end of the day, right? So you got the distractions coming in from the retail side of things. And I just showed you guys how small $1.4 billion is, right? I mean, this is literally embarrassing that people think that that's what moves the markets. Boom. That's not even any one of these candlesticks. None of these candlesticks is $1.4 billion. Maybe if you go down to like the 1 minute time frame, right? Um, but what I'm trying to get you guys to see is the news came out right here. All the news that I just read to you guys came out right here at the top when the market liquidated these previous highs, right? So you can clearly see that this impact and this pullback that we're currently experiencing was due to some form of market maker becoming uncertain in their buy positions and having to readjust, right? So to continue and just looking ahead, all right, monetary policy. The Fed's next move will hinge on how persistent inflation proves to be. If inflation and inflation expectations remain elevated, calls for immediate rate cuts will recede. Additional data points like non-farm payrolls, CPI, and future PMIs will inform the pace and direction of monetary policy. I forgot to add core PCE in there, which we get on Friday, February 28th next week, I believe, if I'm not mistaken. So that's going to play an important role because that's the Fed's primary inflationary measure, right? Higher PCE readings showing stubbornly high inflation or elevated inflation is most likely going to deteriorate risk sentiment and push back on rate cut bets. If next week, inversely, we see lower inflation readings solidifying the Fed Bostic's perspective of 2 rate cuts this year, that's going to boost market sentiment and put back rate cut bets on the table. All right. We'll get to that next week. I don't want to jump too far ahead. I talk a little bit about consumer sentiment, market sentiment here. Risk assets will likely remain choppy, as I continue to mention. Investors will weigh each new data release. That's why I continue to just say be data dependent while we have all these implications in the market right now, particularly on inflation growth to infer whether the Fed's tightening cycle might be extended or if a dovish pivot is still possible later this year, which I firmly think it is, as long as the inflation data shows that it is. If not, then we just have to adjust to that. Okay, we cannot marry a bias. So to sum this all up and to just leave you guys with kind of a optimistic perspective in the back of your minds, because I don't want anybody to think that I'm calling for some kind of crazy crash. We will react to that if it happens, but right now that is not a reality. This pullback, however, is. So recent macroeconomic data has reintroduced fear and uncertainty to the market narrative, undermining the rate cut optimism sparked by dovish Fed commentary yesterday, which we know was a primary driver of risk assets. Surging inflation expectations and sliding consumer sentiment painted more precarious economic outlooks, indicating that the Federal Reserve may not be in a position to pivot to easier policy as swiftly as some investors had hoped. That's how I kind of ended this over the weekend. We need to be mindful. I personally will be watching for any economic updates. There's obviously, of course, no data releases over the weekend, so we need to be paying attention to developments around tariffs and closely monitoring any news from the Russia-Ukraine situation. Keep in mind, recently, former President Trump stated on a Fox News radio interview that it was not important for the Ukrainian President Zelensky to participate in peace meetings. And he reiterated that he would open a call to Zelensky. He also commented that the conflict could even be avoided or could have even been avoided, indicating ongoing geopolitical complexities that could affect the market sentiment. So just be mindful. Any positive developments will obviously, of course, steer investor sentiment towards risk assets. Anything that the market perceives as negative surrounding tariffs over the weekend or geopolitical tensions over the weekend is going to weigh on market sentiment. That's really all we have to pay attention to. And my previous analysis still stands that I've continued to give you guys. I remain bullish above $3 trillion. I still anticipate choppy price action. And I'm still prepared to react if conditions worsen and we slip below $3 trillion, using those opportunities on discounted days to strategically position myself at discounted levels. All right. So I'm just trying to show you guys how I've survived in the market. I'm trying to paint a picture for you guys to understand what really actually moves these markets. I could not imagine being a retail trader that actually thinks that this $1.4 billion event that took place, that happened today, is what is the reason as to why assets across the board outside of ETH bled today.